A tax freight train is bearing down on your retirement. To protect yourself, you'll have to harness the power of zero. Welcome to the Power of Zero show. This is your host, David McKnight, best-selling author of The Power of Zero, Look Before You Lerp, The Volatility Shield, and Tax-Free Income for Life. If you're looking for someone to help you navigate all of the pitfalls that stand between you and the 0% tax bracket, head over to davidmcknight.com. We're happy to connect you with a member of our elite POZ advisor group, trained, vetted, qualified personally by me, among the very best tax-free financial planning specialists in the nation. If you are a financial advisor looking to level up your game and incorporate aspects of the Power of Zero paradigm into your practice, head on over to powerofzero.com. Opt in to our 3-part video series. At any point during that video series, you can schedule a call with us. Would love a follow on Twitter. It's at McKnight&Co, at McKnight&Co. If you haven't watched our film, The Power of Zero, The Tax Train is Coming, you absolutely should. If you don't believe that tax rates in the future, even 10 years from now, are likely to be dramatically higher than they are today, I would head over to, whether you watch it on Amazon, pretty much anywhere you stream movies, you can watch that. It's about 75 minutes long and will really inform your understanding of what's likely to happen in our country over the course of the next 10 years when it comes to tax rates. Okay, we've got an interesting podcast today, and it's based on an email that one of our elite POZ advisors got over the course of the last week. I was holding a webinar with this advisor, and one of the people that was attending the webinar emailed in a question in advance of the webinar, and I responded to this question on the webinar. And it was an instructive sort of exchange, and I thought that I would share with you what we talked about and why it can figure prominently in various strategies and decisions you make when it comes to wringing out the most efficiency out of your retirement dollars once you retire. So basically, this person emailed in and said that they were planning on liquidating some company stock to pay for some lifestyle expenses in retirement. And this liquidation of stock would have resulted in paying some long-term capital gains taxes. I guess the amount that he was planning on liquidating was so substantial that he was wondering that if he should put off doing Roth conversions because of it. In other words, he thought that the liquidation of the stock and the ensuing long-term capital gains that he would have to pay would force him into a higher tax bracket when it comes to his Roth conversion. So I thought that this podcast episode would be a good opportunity to outline the basic differences between long-term capital gains and ordinary income taxes and show how they sort of interact with each other from a taxation perspective. Well, for starters, we know that long-term capital gains do get added to your adjusted gross income or your AGI, which is important because AGI determines whether you can contribute to Roth IRAs or when you get phased out of certain deductions. However, it's important to note that long-term capital gains get taxed in a completely different tax cylinder with completely different tax rates when compared to ordinary income. For example, we know that ordinary income flows into your tax cylinder. Some of it gets taxed at 10%, some at 12%, some at 22%, some at 24%, some at 32%, some at 35%, and some at 37%. We also know that short-term capital gains flow into that very same cylinder and get taxed at the exact same rates. Long-term capital gains, however, are a totally different animal. In fact, long-term capital gains have their very own schedule. They've got their very own tax cylinder. There are only 3 tax rates in that tax cylinder. It's 0, I love 0, 15, and 20. And the rate at which your long-term capital gains get taxed actually depends on what your ordinary income tax rate is in that particular year. In other words, what is your taxable income? For most people in retirement, it's going to be their gross income. Take away the standard deduction, that gets you to your taxable income. That is the number that drives the tax rates on the long-term capital gains side. By the way, the numbers we share today are good through 2025. It's part of the Trump tax cuts. They expire basically December 31st, 2025. And then January 1st, 2026, we revert back to the scenario that we enjoyed in 2017. So for 4 more years, this is how the long-term capital gains cylinder is going to work. If your taxable income is between $0 and $83,350, then your long-term capital gains are going to be 0. If your taxable income is between $83,351 and $517,200, and your long-term capital gains tax rate is going to be 15%. And if your ordinary income, your taxable income actually is greater than $517,200, then your long-term capital gains tax rate is going to be 20%. So that's going to affect, the top 1% of the country. So now that we've established a basic framework of understanding, let's return to the original question that this individual had. Will liquidating stock to pay for lifestyle and retirement and incurring long-term capital gains along the way bump him up into a higher tax bracket when it comes to doing Roth conversions? The answer, in short, is no. And that's because your long-term capital gains, again, are taxed in a completely separate tax cylinder than your Roth conversion, which is taxed in your ordinary income tax cylinder. However, the amount of ordinary income that you have, or really the amount of net taxable income that you have, does inform the taxes you pay on your long-term capital gains taxes, okay? And all of this begs the question, which one of these calculations do you perform first? Do you perform the long-term capital gains calculation first, or do you perform the ordinary income taxation first? The answer is you always perform the ordinary income tax calculation first. That then informs the rate at which you pay taxes on your long-term capital gains tax rates, be it 0, 15, or 20. So here's an example. Let's say you want to convert your Roth IRA in a given year enough to fill up the lower 10 and 12% tax brackets. That means that you would be able to convert right up to the top of the 12%, which is $83,350, plus an additional $25,900 for your standard deduction for a total of $109,250. So you could convert $109,250 from your IRA to your Roth IRA in that particular year. Remember, your standard deduction can be used to offset any ordinary income, including income from Roth conversions. Let's also say that you want to liquidate $150,000 of stock, the basis of which is $50,000, and that's going to be a long-term capital gains. And you're going to use that to pay for your lifestyle. That transaction will produce a long-term capital gain of $100,000. So here's where it's important to sort of remember the order of taxation. First, the income from the Roth conversion will flow into the ordinary income tax cylinder and be taxed at the 10 and 12% brackets. Okay. Once you take away the standard deduction, that means you're going to have $83,350 of net taxable income, which now will inform the rate at which you pay long-term capital gains on that $100,000 of realized long-term capital gains. Because your Roth conversion consumed your 10 and 12% tax brackets, that long-term capital gain will be taxed at the 50% long-term capital gain tax rate. Why? Because from an order of taxation perspective, we had to tax the Roth conversion first, which consumed the 10 and the 12% tax bracket, pushed us right up to the $83,350 threshold. Then we perform the tax calculation on the long-term capital gains. And because any time you have long-term capital gains and you have taxable income that's $83,350 or more, then you get to pay tax at percent. So, in summary, when doing these types of long-term capital gains calculations, we always have to calculate the tax on the ordinary income first. That will then inform the rate at which we pay taxes on those long-term capital gains. So in an answer to the person who emailed in, liquidating company stock to pay for lifestyle will not force you to pay higher tax rates on your Roth conversion. In fact, I would say that because you are using stock that has long-term capital gains to pay for your lifestyle, that is precisely the time in which you should consider doing a Roth conversion. One other consideration. Let's say that you have $10,000 of capital gains. And let's also say that your taxable income is $78,350, or basically $5,000 shy of the top of that 12% tax bracket for a married couple. That means that $5,000 of that $10,000 capital gain will be taxed at 0% because it's below the $83,350 threshold. And $5,000 of that capital gains will be taxed at $5,000. Why? Because when considering the taxation of long-term capital gains, it always gets piled right on top of your taxable income. In this case, like I said, $5,000 gets taxed at the 0% rate because that $5,000 is below the $83,350 threshold. And then once your income gets above the $83,350, then that remaining $5,000 of long-term capital gains would be taxed at 15%. So the long and the short of it is, once you start to understand these different rules, you can implement some pretty interesting strategies when it comes to trying to get to the 0% tax bracket. So for example, if you're looking to do a Roth conversion, you've got some company stock, you know it's going to be long-term capital gains. This might be an excellent time to live off of that stock. You get to pay taxes at historically low tax rates over the course of the next 4 years. And then anything that you convert from your IRA to the Roth IRA is going to flow first into your tax cylinder. You can tax to the top of the 12%, $83,350, throw in another $25,900 for that standard deduction. You could get a significant amount of money shifted from tax deferred to tax free, and you're simply living off of your company stock or whatever other stock you have for that matter, so long as it's long-term capital gains. Now, if it's short-term capital gains, all bets are off. It all goes into the same cylinder. But if it's long-term capital gains, there's some really, really interesting strategies that you can implement once you understand the difference between those two taxes and the order in which they're taxed. Once again, the ordinary income on the Roth conversion gets taxed first, and that informs the tax rate on long-term capital gains. And the long-term capital gains calculation takes place second. So basically, a lot of this can be confusing, which is why I would encourage you to head over to davidmcknight.com. Like I said, we're happy to hook you up with a member of our elite POZ advisor group, among the very best tax-free retirement specialists in the nation. They're well-versed on these types of issues and can help you wring as much efficiency out of your retirement dollars as possible. And if you're a financial advisor who wants to learn more about these things, head over to powerofzero.com. Once again, would love a follow on Twitter. It's at McKnight & Co, at McKnight & Co. Even if you want to follow me on Instagram, I'm starting to post more and more things on both of those channels. That's David C. McKnight. It's David C. McKnight. Would love a review on our movie, any of our books, or on this podcast for that matter. Folks, really appreciate you being with me this week, and we will look forward to chatting with you same time next week.